How is everybody doing? It is Friday night, and you are in the strategy room with the banker next door. Thanks everybody for being here tonight. I got a ton of stuff for everybody tonight. We're going to be talking about some open banking here shortly. In just a second, we're going to be talking about the absolutely dismal job numbers that came out earlier today, and we're going to talk about some different aspects of the labor, market. Job openings, not just jobs created, kind of what's other things that may be going on there. Tons of different things going on as far as bank earnings, different things happening with Zelle. A lot of interesting things here tonight that I got to talk about, some commercial real estate stuff, but a ton of stuff for everybody here tonight. So I'm going to open up here and I want to dive into open banking to kind of kick us off here tonight. So we had some very interesting things that happened. I'm just going to make this a little bit bigger here for everybody so everybody can see this. So the Consumer Finance Watchdog, the CFPB, they basically finalized the open banking's rule aimed at, supposedly they say, driving competition. But the CFPB faces industry pushback on the move to let customers share financial data between banks and link their accounts with apps. Now, this was an article in the Wall Street Journal. So basically it just says, a U.S. Consumer Finance Watchdog, the CFPB. I don't know why they're the Finance Watchdog thing. Just call them by their name, the CFPB. Finalized rules that will allow customers to transfer their bank data to another bank or allow third-party apps to access it without having to pay fees or clear other hurdles designed to make such moves difficult. The so-called open banking rules could reshape the consumer finance landscape by making it easier for upstart tech companies offering services ranging from digital wallets to financial management tools to gain access to consumer data that has long been tightly held by banks. I love how they say could make it easier for startup fintech companies, not Google or Amazon or Microsoft. Not make it easier for any of the big boys to get at your money and your data. Just these so-called startups. Like, okay, two banking groups on Tuesday said they were filing a lawsuit to block the regulation. Yes, finally, let's go here. So the move by the CFPB on Tuesday follows through on a promise by President Joe Biden, make it easier for consumers to download the financial data. But then it goes on to say here, too many Americans are stuck in financial products with lousy rates and services. Really? So where's the information on that? Today's action will give people more power to get better rates and services on bank accounts. How? The idea to give customers more control over their financial data stretches back to the Biden administration. Yeah, this whole idea, and this is where I say about this, like, this is going to give you zero control over your data. Zero, none. Like this, it will give a lot of other companies control over your data, but it's not going to give you any control over your data. And like I said, and this is, I went on a whole diatribe about this last week, basically talking about open data, the way that they were painting this thing versus the realities of it. But I wanted to point out here though that basically so where we're at is that the CFPB has finalized the rule, and then a couple of bank groups basically filed a lawsuit this week. And I want to go and take a look at this article here real quick. Basically says banking trade groups call for open banking innovation driven by the market, not by the CFPB. So banking trade groups expressed fears that the new open banking rule will add substantial unnecessary compliance burdens in a market that already functions well. The CFPB issued their final rule on October 22nd under Section 1033 of the Dodd-Frank Act, requiring financial institutions to share data. But however, the Bank Policy Institute and the Kentucky Bankers Association filed a lawsuit challenging the CFPB's authority in the rulemaking process. And then, according to the lawsuit, the trade groups called the regulation a bureaucratic intervention and counterproductive. They raised concerns about heightened data security risks, the reliance on private standard-setting organizations, high out-of-pocket costs for banks, and a substantial and unreasonable risk of liability. Yes, correct. Everything that I stated last week in terms of in other words, the high out-of-pocket cost for banks. They were going to have to spend millions, maybe even tens of millions of dollars to build the so-called portal that would allow companies to hook up to the back end of the bank. So it's going to cost banks a huge amount of money. Then you've got the heightened data security risk. Just like I said, the cybersecurity part of this, they want to use APIs, which are not secure. The APIs are not safe. They're not secure. You're going to have major data risks, and you're opening up the banks to, again, just like it says here, a substantial and unreasonable risk of liability. Yeah, I mean, just absolutely. So then the CFPB director, Rohit Chopra, said in a statement that the rule is an important step toward a more open and decentralized market, yada, yada, yada. And then, the CFPB's authority challenge, what banks are taking aim at is not the concept of open banking using application program interface, again, API, to send banking data to other banks or fintechs for their consumer-facing products, but the federal regulatory regime. Some in the industry argue that they could have more flexibility in practices without a federal rule. Yes, I would agree with that. The banks would have more discretion as to who they do business with. They wouldn't be potentially required to provide all of the information if they didn't want to, says John Coleman, a partner at Orrick, Henrington, and Sutcliffe. So by mandating banks must hand over, that's the key word there, must hand over sensitive customer account data to any third party that got someone to click I accept on their app. This rule handcuffs banks' ability to demand high security standards from third parties. And then suing a regulator in the post-Chevron era. So the outcome of the rule is even more uncertain since the Supreme Court decision to overturn Chevron's deference gave banks more power to push back against regulators. Because of the Chevron ruling, agencies across the board are facing challenges on whether they are acting within their legal authority as defined by the laws they are supposed to enforce, said Greg Zwitzky, a partner at Ballard Spahr. So similar dynamics can apply to the CFPB in this lawsuit. Yes, I would definitely say that. And I'll get back to that in just a second here, but this kind of wraps up by saying, looking forward, no matter the outcome of the lawsuit, banks large and small should think through their strategy in open banking. If the court decides the CFPB did not exceed its authority and the rule takes effect, the earliest compliance date, April 1st, 2026, for certain financial institutions will creep up quickly. Yes, I would say I would absolutely agree with that. But let's go back to Chevron for a second here. Part of this is the whole open banking concept. I think the fact that the CFPB, the head of the CFPB, just decided that, hey, we're doing this. We're going through, didn't really care what the input was from banks, just basically said, no, we're doing this. That's it. This is the fiat on high. And this was the whole point of Chevron. It was basically saying that government agencies have just completely overstepped their boundaries, that it's not Congress passing laws anymore. It's the agencies. The agencies just come in and say, well, we're creating this. We're doing that. We're changing this. And you just have to live with it. And there's not really any way to, or at least pre-Chevron, there was really no way to push back upon that. It was basically like, whatever the regulatory agencies did, that was that. That's the Chevron changed. Chevron has changed the game. That is not going to be the case anymore. These regulators are going to get taken to court and they are going to lose. They're going to lose on some of these things. It depends on the judge they get in front of, and not everything is going to be a win for banks and stuff that challenge these things. But they're going to get banks are going to get some wins, and they're going to get some pushback on some of this stuff, and it's going to cause these agencies to think long and hard about, well, is the juice worth the squeeze? Is it worth it for us to kind of head down this road? So and then I just want to show this real quick. So I want to show this. So this is Jamie Dimon versus Rohit Chopra, who's the head of the CFPB again. The CFPB chief goes wild on regulation as he hunts a promotion under Kamala Harris. So JP Morgan CEO Jamie Dimon told a banking conference Monday that he's tired of this bleep. from the Biden-Harris regulators. Perhaps he has in mind the extraordinary power grab by the CFPB under Director Rohit Chopra. The CFPB recently slapped Fairway Independent Mortgage Corp with a $10 million fine for allegedly discriminating against minorities. Its evidence? Fairway's ratio of lending in majority white versus majority black census tracts in Birmingham, Alabama, was higher than that of other lenders. The CFPB offered no proof of intentional discrimination, and Fairway says it made more loans in majority black tracts than other non-bank lenders. Fairway also says that the CFPB ignored its lending to buyers who moved from majority black to other neighborhoods, which indicates the government's preference for furthering racial segregation. Fairway nonetheless settled the complaint because doing so was less expensive than defending itself in court. Its $10 million payment will most likely fund subsidies for low-income housing in minority neighborhoods. But Mr. Chopra is using his enforcement power to finance the left's housing agenda without an appropriation from Congress. Or consider the CFPB's guidance last week regulating employees' background checks and information that employers use to rate workers' performance under the Fair Credit Reporting Act. That's the law that regulates how credit agencies collect and use consumer data. Many employees use third-party technology to conduct background checks, monitor sales and customer service interactions. As well as time workers take to complete tasks and spend web browsing, among other things. But progressives and unions don't like employers monitoring and measuring workers. So the CFPB is seeking to make this harder by requiring employers to follow the same rules as credit reporting agencies when they collect financial information on individuals. This means employers will have to let potential hires and employees dispute negative information collected on them. So so let's see here. But then it goes on to say here that Mr. Chopra's guidance can be challenged in court because it isn't a formal rule. Yet if employers violate this dictate, they can be fined. And then we get to Mr. Chopra last week also issued an open banking rule that requires banks and credit card companies to share customer data at no cost with a third party upon the customer request. But regulating competition isn't the Bureau's responsibility, and federal law doesn't authorize his mandate. Dodd-Frank requires banks to make available to a consumer, upon request, information in the control or possession of the bank concerning the consumer financial product or service that the consumer obtained from the bank. But Mr. Chopra has redefined consumers under the law to include third parties such as fintech startups and even scammers. This means banks will have to turn over customer data to third parties to initiate payments from customer bank accounts. Banks will be legally liable if their customers are swindled. So Mr. Diamond of JP Morgan told the banking conference that it's time to fight back. We are suing our regulators over and over and over because things are becoming unfair and unjust, and they are hurting companies. A lot of these rules are hurting lower paid individuals. Absolutely. And I am so thankful that, look, Jamie Dimon, he's the biggest banker in the country. He's the most well-known banker in the country. And I'm so happy that he has finally stood up and basically said enough is enough. We have to start pushing back on some of this stuff. And it's not the reason why I read through that article. And I basically went through the thing about Fairway Mortgage or Fairway Independent Mortgage Corp. And then the guidance last week on regulating employee backgrounds and then open banking is that I wanted to show the pattern of what the CFPB has been doing and about how they have been overstepping their bounds, and they've been just doing things as they see fit. Again, they are the ruler. Everyone else is the plebes, and they can do as they see fit, and to heck with everybody else and whatever anybody else wants. That's not the way, again, our system is supposed to work. The regulators are simply supposed to be there to enforce the laws that are passed by Congress. They're not supposed to just arbitrarily create their own rules, their own regulations. Like, that's not their mandate. So again, I'm glad they're getting sued. I'm glad some of these banking associations have finally stepped up to push back. And again, this is not about being this is not about being like disrespectful to the regulators, and it's not about being anti-regulation. This is about when, when regulators and the government overstep their bounds. Sometimes you do have to stand up and you do have to push back against some of this stuff. That's, that's the kind of the nature of the beast. That's why banks have banking associations. That's what the whole purpose of the American Bankers Association and state banking associations, that's what they're there for. They're there to, to work on behalf of banks to try to, push back when things need to be pushed back on. So, but, just a lot of news here. Finally, I was happy to finally see something was happening here with the open banking. So now that we have lawsuits, now that we have Jamie Dimon pushing back against this, I really hope that every bank in this country, I hope that consumers, step up to this and basically say, forget this. We're not doing this. We don't want this. Because it's just it's crazy. I think this whole concept of open banking. And again, somebody who was making the argument would probably say like, oh, well, they have open banking in Europe and it's great. And, and Europeans have any problems with it. Well, I think that's debatable. I think that, yes, they do have open banking in Europe. Yes, it's been over there for a few years now, but how do people feel about it? Do they really want it, or did it get shoved down their throats? I would be willing to bet that it got shoved down their throats, and most people over there probably don't like it or didn't want it to begin with. So, but again, we'll have to keep an eye on this. We'll have to see what happens. But like I said, I'm highly, highly encouraged that we finally got some action on this, and we're going to go from there. So okay, that's my rant here on open banking. So I want to move on to some other stuff. We're going to get into the jobs thing in just a second here. But first, I just want to go over what are some of the economic indicators that are going to be coming up this week. So on Monday, November 4th, we got factory orders coming up. We also got the 3-year Treasury note auction. On Tuesday, November 5th, we have obviously the U.S. presidential election, because none of us have heard enough about that, right? Trade balance. Services PMI. We got the ISM non-manufacturing PMI. We get the 10-year Treasury note auction, API weekly crude oil stock. On Wednesday, November 6th, we have the services PMI. We have the 30-year Treasury bond auction. On Thursday, November 7th, we get the continuing jobless claims, initial jobless claims, non-farm productivity, Fed interest rate decision. Obviously, big there. I think they probably will cut another 25 basis points, but we'll see. FOMC press conference following that at 3:30, and then the consumer credit at 4. And then finally, on Friday, November 8th, the Michigan consumer sentiment, the WASDE report, and the U.S. Baker Hughes oil rig count. So a lot of stuff happening next week. Obviously, Tuesday with the presidential election, and then the 10-year Treasury auction. That'll be big stuff. And then obviously Thursday with the interest rate decision, the FOMC press conference. I mean, all eyes are going to be on that to see kind of what happens and what goes down there. So we got a lot of stuff coming up next week there. So, but now let's talk about some of the other things that happened this week. Let's talk about this abysmal jobs report that came out here today. And where am I at here? Okay, hold on. Job openings. Here we go. The U.S. economy added just 12,000 jobs in October, impacted by hurricanes and the Boeing strike. So obviously, the economists, it says here, revisions lowered previously reported job creation totals by 112,000 for August and September combined. Again, let me read that again. They revised lower. This is what I keep saying. Every month they have the headline number comes out and it looks great, but then the next month comes in and then they hit you with the revisions on the last month. So the revisions lowered previous reported job creation totals by 112,000 for August and September combined. So again, the jobs reports going back the last few months have been abysmal. Non-farm payrolls increased by 12,000 for the month, which is nothing, down sharply from September and well below what the Dow Jones estimate was for 100,000. So the unemployment rate miraculously somehow held steady at 4.1%, which, yeah, okay, whatever. The BLS noted that the Boeing strike likely subtracted 44,000 jobs in the manufacturing sector, while hurricanes also likely held back the total. Sure, I can absolutely, but I think the issue in the labor market is far worse than that. Let's just put it that way. So, and I just want to go down here. So I want to look at this. So here is the job. Here's a great chart here of monthly job creations in the U.S. going from January of 2022 to here October 2024. And what does this chart tell you? Just don't even look at the numbers. Just look at the bars. And this tells you could see the deceleration in the employment market. You can see it just going down, down, down. And when you go back here, you count each month. I would say something like 16 out of the last 17 months were all revised lower the following month. So in other words, it's like I said, they give you a good headline number, and then they go back the next month and revise it lower. Now, this month, we got just an absolutely abysmal number at 12,000 jobs. I mean, that is just, I can't explain to people, like, that is literally nothing, absolutely nothing. So, but let's look at the last few months here. So we had like May 216, June 118, July 144, August 78, and then September somehow 221,000. Yeah, okay. And like I said, and then we dropped all. How do you drop from 221,000 all the way down to 12,000? Even with the strikes, or even with the Boeing issue, even with the storms, the hurricane, like, okay, you take some off, you still should have created 100,000, 150,000 jobs. Like, how do you go from supposedly 221 down to 12? So, and I would really willing to bet if it's 12,000, that means the real number is negative. That's what I would say about that. Is, so when you look at the headlines, I would say that next month, next month in December, when we get the November numbers, we're going to get the revision, and I guarantee you it's going to be negative. So, just not a good look here. And like I said, and I truly believe that the job market is a lot worse than what they've actually been telling us. It just is what it just is what it is when you look at what's really, you dig behind the numbers, basically. So, okay, let's look at a couple other things here. I want to look at job openings fell and hiring rose in basically a mixed bag report. So the number of job openings fell in September, but hiring increased, painting a mixed picture of the state of the labor market. So employers remained reluctant to lay off employees, and workers were less likely to quit, suggesting people were less confident of finding better options in their current situation. Concerns about the health of the labor market have prompted the Federal Reserve to cut its benchmark interest rate, and the September job openings report left expectations for another cut in November unchanged. U.S. employers cut back on job openings in September, but stayed conservative about both hiring and firing as the overall market stayed stable, but got more stagnant. So there were 7.4 million job openings in September, down from 7.9 million in August, and the fewest since January of 2021, the Bureau of Labor Statistics said Tuesday. That was fewer than the 8 million openings economists had expected. And the dwindling number of open positions was a sour note in the job openings and labor turnover survey report, which provides a more detailed look at the labor market's churn. And then it goes on here to say the workplaces laid off 1.8 million people, the most since January of 2023, though relatively few compared to pre-pandemic levels. Fewer people quit their jobs, suggesting they were less confident of finding a new one. 3.1 million people quit in September, the fewest since August of 2020. So I just want to say a couple things here about job openings. So we had hit a high of about 12 million. And now we've dropped, over the last couple of years, we've dropped all the way down now to 7.4 million. But I also did an episode a few months back where I talked about basically the labor market and ghost job postings, and basically about how almost half of all job postings are basically fraud. They're fake. They're basically fake job postings. So in reality, I don't think you have 7.4 million job openings. I think you probably have something more like 4 million real job openings right now, which again is not good for the labor market. So I think you look at the job openings, You look at the number of quits, you look at the number of layoffs, you look at the number of jobs being created. And I think when you take that into account, it does not paint a good picture of the overall labor market. And then finally, I want to talk about this on the whole labor market front. So this article is called "Layoffs Surge in U.S. White Collar Jobs as Rates and AI Alter Office Work." So 1 in every 4 American workers that have lost their jobs this year worked in professional and business services, a sign that the white collar labor market may be strained under the weight of high interest rates, and the technology advances may already be making some workers obsolete. In September, employers shed 497,000 professional and business service jobs, which includes accountants, consultants, and legal workers, the highest for the group in nearly 2 years and more than any other sector during the month, according to the Bureau of Labor Statistics data released October 29th. Through the first 9 months of 2024, professional and business service sector jobs accounted for more than 3.7 million of the nearly 14.9 million layoffs and discharges in the U.S. While the exact cause of these job cuts remains unclear, it could reflect a cyclical weakness sparked by higher interest rates and overall restrictive monetary policy hindering investment and employment. It may also reflect more structural changes, with the rising number of layoffs and stalling growth in the sector potentially connected to new technologies such as AI, replacing white-collar workers and improving productivity with a smaller number of employees. If those trends stick in the coming months, even as interest rates fall and activity in various markets revives, that could be evidence in support of the theory that the economy is fundamentally changing due to new technologies. Yes, but again, I just did an episode kind of on the effects, if you will, of AI, and how we're really not seeing those effects yet in the economy. I think that the underlying issues here are basically inflation. I think inflationary pressures. I mean, you look at what's happening with restaurants, and let's look at this. Professional and business services had the most layoffs and discharges in September, followed very closely by leisure and hospitality. You look at, like I said, restaurants. I mean, restaurants are getting killed right now. The cost of food just keeps going up. It does not stop going up. The cost of labor. So I mean, and restaurants, you can only pass but so much of the cost onto your customer. Like, in other words, if you're take Red Robin, for example, right? Can Red Robin, if you have a family of 4 come in, can Red Robin afford to start charging each one of those family members basically $50 for a burger and have them walk out of there with a $200 bill for a couple of burgers and some fries? No, that's not happening. Red Robin would literally go out of business. So they have to, their margins are already thin to begin with, and they're getting thinner. I think the real reason why the professional and business services, why you're seeing so many layoffs here, is that I think, number one, during the pandemic, especially with you think of like the big tech companies, I think they overshot their target in terms of hiring new employees. I think they way overhired. Now that I think costs are going up, I think in an effort, I think companies are trying to get lean and mean, if you will. So I think that the stew, if you will, the pot, you've got higher interest rates in there. You've got inflationary pressures from, increased wages, increased costs of products, increased costs of services, increased costs. Everybody's had to increase their costs, whether it's accountants, lawyers, consultants, fintech providers. Like everybody's raising up their prices. So that begins to take a toll after a while. I'm pretty sure. I mean, pretty soon, your margins start getting squeezed, and sales are okay, but they're certainly not lighting the world on fire. And if some companies start to see their sales dipping, they're going to say, okay, if I can't increase revenues, I got to cut expenses, and they're going to try to find ways to cut back. So I think that all of those things, I think that the over hiring for a few years, I think inflationary pressures, the interest rate pressures, I think the slowing down of the economy, the slowing down of sales has just led a lot of companies to basically say, you know what, we either can't afford you, or we're basically being forced to get, lean and mean. And companies might look at it too, like some might also be hedging their bets, saying, you know what, we see a recession kind of on the horizon, and we want to, kind of trim the fat, so to speak, and kind of get ready for that, so that when after that's over, we can kind of hit the ground running coming out of that recession. So let's see here. Layoffs and discharges of professional and business service workers hit new high. And yes, you can see here, going the trend here over the last, year or so, just going right on up. Not in a straight line, but going up overall. And anything else here? Higher pressure, flatlined. Yeah, so this is basically hiring of professional and business service workers has flatlined, and you can just kind of see there. Not really a whole lot going on there at the moment. And then like I said, job openings are falling near pre-pandemic levels as quitting declines. So like I said, overall, I think the picture is that the numbers that are being presented on the labor market are not that great. They're not that hunky-dory. And, the job market is just nowhere near as strong as what's being painted. And basically, and this is a huge concern. I think this is why the Federal Reserve is going to continue to reduce rates. They're going to continue to cut rates. And, we'll have to see. And then, like I said, we'll just have to continue to see what happens there. So, okay. I wanted to look at, where was my GDP numbers? Yes. Okay. I wanted to look at the U.S. economy grew at, and what was this in? This was in, okay. So we got GDP numbers this week. It basically says the U.S. economy grew at a 2.8% pace in the third quarter, less than expected. So gross domestic product increased at a 2% annualized rate in the third quarter, but it was below the 3.1% estimate and the 3% reading for the second quarter. Consumer spending and federal government outlays were two of the biggest contributors to GDP growth. The release comes with the Federal Reserve poised to lower interest rates further, despite the seemingly strong economy, and inflation remains above target. So, and it says here, obviously, the U.S. economy came in, 2.8%. Again, I jump all over the GDP numbers, just like I jump all over the inflation numbers, the job numbers. I just believe that when you dig into these numbers, and I've done episodes on this with the gross domestic product, this number is really been driven by government spending. Like, government spending is what is driving this GDP number right now. If you take that government spending out, that GDP number is way, way down. And then what were some of the inflation numbers that came out this week? So personal consumption expenditures, a proxy for consumer activity, increased 3.7%, which they said was the strongest performance since the first quarter of 2023. Another major factor cited for the growth was federal government spending, which exploded higher by 9.7%. Pushed by a 14.9% surge in defense outlays. Fiscal spending at the federal level contributed 0.6 percentage points to the GDP growth rate overall. So you have it right there. And it just says the growth was federal government spending, which exploded higher by 9.7%. So it goes back to my point there of the government spending driving the GDP numbers. But I thought it had some information here. Okay, yeah, this was it. So, and then it goes on here to say there was good news on the inflation front. The personal consumption expenditure price index, the Fed's preferred inflation gauge, rose 1.5% for the quarter, below the central bank's 2% target and sharply down from the 2.5% increase in Q2. However, excluding food and energy, core PCE was still up 2.2%. That's right. Core PCE, the number that really matters, has actually increased each of the last 6 months. It has not come down in 6 months. And this is why you're seeing, the price at the food stores not coming down. It's still going up. And then Fed officials generally consider core inflation as a better measure of long-term trends. And it says, consumers have been using savings and credit to help fuel their purchases. Well, not savings, because they've blown through that, and not much credit for much longer, because they've tapped the credit out with $1.6 trillion. I'm sorry, with a T, trillion in credit card debt. The personal savings rate decelerated in the third quarter to 4.8%, down from the 5.2% level that had been revised up sharply. Yeah, not so much. The pace of price increases was slowly considered since, though the PCE index has risen nearly 17%. No doubt. So again, with the inflation numbers, it's like, yes, okay, inflation is slowing, but it's not coming down. Like that's the point. It's like they say, oh, well, look, we looked at the CPI and that's coming down, but what does the core CPI say? Oh, the core CPI has increased each of the last 6 months. Oh, well, let's look at the PCI or the PPI. Oh, well, PPI is down, but then you look at core PPI. Oh, that's up for the last couple months. It's like, so in certain respects, inflation is very much still elevated and still expanding. And yet they're looking at the numbers that let's look at everything like, oh, let's exclude food and energy and everything else. And then, oh, look, the number, it's coming down, whatever. So it's not that inflation's coming down. It's just not going up as fast. But again, the problem lies in the fact that you look back over the last 3 years and you look that some products are up 30, 40, 50%. That's huge. And none of that has come down. None of that has gone away. And therein, lies your problem. Prices aren't, coming back down. So, but like I said, so I just think that what should we all take away from this big picture? Well, the labor market is not that hot. The GDP numbers are being juiced by government. They're completely out of control, government spending. And the CPI numbers are still high, still elevated. And I think there's still a very big risk that inflation gets reignited, especially if the government does not get the spending under control there. So, okay. So that was my, piece de resistance on the on the things there. Okay, well, all right. So I got a ton more here to get to for a second, but I want to stop for a second. I want to jump out of this for just a second, and I just want to talk about some of the episodes that I did this week. So I had going back to last Sunday, I had episode 254 premiered, and that was just an update on banking industry ratios and interest rate risk. Kind of how is the industry looking overall? And I basically showed that industry ratios overall are holding pretty good, but there is there's a lot of interest rate risk sitting there in banks' loan portfolios and things right now. Definitely things they need to be concerned about. Then I did episode 255, which was ICBA advocacy and action update for the fourth quarter of 2024. And I kind of went over what are all the kind of hot button regulatory issues going on in banks right now. We talked about open banking and some of the other things that are happening there. And then I had the latest edition. I had episode 11 of the crypto series, which was Crypto Fraud is Growing. And I talked about the different kinds of crypto fraud that are out there right now. I talked about how the older demographic was the most vulnerable and the ones that were getting hit the most on there with that. And then I did episode 257, which was how was loan demand and business activity for the third quarter of 2024. So loan demand has been weak. It has been weak for the last few quarters, and but there are signs, hopefully, that maybe we might start to see a little bit of pickup in that. Business activity was focused on a New York Federal Reserve report for kind of the New York, New Jersey, Connecticut area. In the Northeast. So, and like I said, some things business activity in certain respects is not doing so hot. But check that episode out when you get a chance. And then finally I did episode 258, which is how is CECL performing? And CECL is an acronym for the current expected credit loss. And it has a lot to do with the banks and their loan loss provisions. How do they put money aside for potential loan losses. When do they do that? Then that's really what CECL is all about. And CECL, for a lot of the banks in the country, is a relatively newer thing, just implemented just within the last couple of years. And so the question really is like, well, how is it doing? How is it doing? How are banks doing with CECL? Is it doing anything better than the kind of more historic credit loss model that banks used to use for decades and decades? So I thought that was kind of an interesting episode. So like I said, check that out when you have a minute. So but before I get into this next thing, so there was an episode that I did back on October 17th. It was episode 248, and it was called "Is CRE, Commercial Real Estate Concentration, a Bad Thing?" And I basically said that not necessarily. It depends on the niche. If the bank has a niche, if you have a certain strategy, then having a CRE concentration is not necessarily a bad thing if you are very good at that particular niche. And so I saw this blog post from Naomi Snyder, who is the editor-in-chief of Bank Director. And I just thought I'd read this to everybody real quick. So bank management teams that concentrate heavily in commercial real estate have been hit for at least a year now with questions about their business models from investors and regulators. Some banks are telling me that regulators are pushing them to reduce their concentrations. The last financial crisis exposed some of the risks of a heavy reliance on commercial real estate loans, and higher interest rates could stress borrowers when their loans reset at a higher rate. There's not a could in there. They absolutely will. Still, some of the top performing banks in the country are highly concentrated in commercial real estate. Per Bank Director's 2024 ranking banking analysis earlier this year, we wrote about Five Star Bancorp in Rancho Cordova, California, Great Southern Bancorp in Springfield, Missouri, and Little Rock, Arkansas-based Bank OZK. So far, CRE has worked well for them, but questions linger about whether top CRE performers can maintain superior performance in the coming years. In most cases, having a concentration is a really good thing, because when you have a concentration in something, that means you've developed an expertise in it, says Adam Mustafa, who's CEO and co-founder of the advisory firm Invictus Group. If you're only doing one or two things really well, as opposed to trying to be all things to all people, that's usually a better strategy no matter what business you're in. Mustafa took to LinkedIn last month to publicize his complaint. I am tired of the term concentration being a negative when it comes to CRE, he wrote. The danger is that banks under pressure to diversify may grow in areas they don't know well and don't properly invest in. For many community banks, there aren't a lot of good alternatives to CRE. Big banks and mortgage giants command the mortgage business. Community banks don't have the size and scale to compete in consumer lending. Commercial and industrial lending is an opportunity, but it has higher loss rates. It also requires a special skill set to underwrite loans based on inventory and accounts receivable rather than real estate collateral. In other words, C&I loans bring their own risk. Someday I'm going to have to tell the story in an episode of Crazy Eddie. If people on here of a certain age, they remember Crazy Eddie, because Crazy Eddie, he did these commercials where he literally had a baseball bat. He had like electronics. Crazy Eddie was kind of like an electronics retailer. And he would have a table with electronics set up, and he would be like $39.95, too much, and he'd take the baseball bat and he'd smash the electronics in front of him. It was like very, very memorable for anybody who remembers seeing that from probably back in the 80s. It was highly entertaining, but Crazy Eddie was a total fraud, and he had fraud. I will definitely have to do an episode on that and how exactly he scammed the bankers that he was working with, because it's like an all-time story. So I'll have to do an episode on that one day, but let me just finish up. So some CRE banks will undoubtedly falter, but others will excel. Warren Buffett once described his views on investment portfolios by saying diversification was fine for people who don't know how to value companies. Diversification is protection against ignorance. It makes little sense if you know what you're doing. So, and I actually agree with Warren very much on that. So I have often said, and I will continue to say about the banking business, is that, banks, I think a lot of times, Europe had this whole thing starting back in the 90s, where they went to what they called the universal banking model. And and they wanted to be all things to all people. And in some respects, I think what they did worked. In other respects, maybe not so. But it became kind of this fad in America, especially going into the 2000s and over the last, 20, 25 years. A lot of banks, trying to be like a supermarket, a shopping center. Oh, we'll have an insurance line, we'll have wealth management, we'll own a title company, and we'll do this, and we'll do payroll, we'll do all this other stuff, and a lot of times you see that banks, they get into this stuff and then they get out. They do it for 4 years, 5 years, maybe even 10 years, and then they're like, yeah, you know what? Looking back over the last 10 years, we really didn't make any money doing this, and it really cost us a lot of money, and really doesn't make sense. And oh, hey, if we can get a nice premium, let's just dump this thing and go on. And so my point there being is that there's nothing wrong with just making a dollar at what you're good at. If you've got a specialty, if you've got a niche, just work that niche. I'm trying to think. I'm thinking of Jim Collins. I'm thinking of Good to Great. If anybody ever read Good to Great, or if anybody has ever heard Jim Collins speak, he often talks about, in that book, he talks about the flywheel, and he basically talks about how you got to turn the flywheel. You got to turn the flywheel, and you got to get the rotations going, and you got to get it faster and faster and faster and faster and faster. And he talks about, the momentum. You got to build that momentum in the flywheel, and you got to push it. And, you turn the flywheel and you build that momentum by just, focusing on the one thing and just working that thing again and again and again. It's not about reinventing the wheel. It's about turning the wheel, turning that flywheel. And so if anybody has not read Good to Great, I highly recommend it. Jim Collins is fantastic. He's got some great YouTube videos out there. If you ever get a chance to go check them out. So, okay. So, all right. We talked about episodes. I went through that. So real estate concentration, not a bad thing. Go check out episode 248. If you get a chance, I kind of give a very specific bank example on that episode. So you can go, kind of check that out. But let's go on to a couple of other news items. So now I'm going to bring our handy dandy back in here. So this is what I wanted to show everybody. So I've talked a lot about beneficial ownership information, BOI, and why it is, business owners, particularly small business owners, need to be aware of BOI. If you don't know, you have to register by January 1st, 2025. I've talked about this a lot. It's, BOI is a huge thing. You're going to have to register for it. I hate it. I don't like it. I think that, I think, again, just like open banking, I think the BOI thing is highly unconstitutional. The National Small Business Association, had their lawsuit, and I, believe they won their lawsuit. But, that only affected people that were businesses that were members of the National Small Business Association, which is a very small number of small businesses in the country. And you had to be a member before they filed the lawsuit back in March of this year. So if you weren't a member before then, it doesn't do you any good. So, I tell people, go on, to the FFIEC website, check out beneficial ownership information, because unfortunately, unless something amazing happens here before the end of the year, unless we get some kind of new lawsuit, or unless the Supreme Court steps in, I don't really see any reason why anything would change before January 1st. So like I said, best to probably go on there in the next few weeks and just register, get it over with, and hope maybe something good happens on that front next year. But here is what PA is doing. So new PA business annual reports. So know the requirements and the deadlines. So basically, who must file, information needed, and the filing process. So basically, this is Pennsylvania's version of the beneficial ownership information. So not only are you going to have to fill this out on the national level for BOI for the federal government with FinCEN, you're now going to have to do this in Pennsylvania. I think part of this on the part of PA is a cash grab. I think part of it is government overreach. And I think, part of it is, again, the insatiable appetite of the government just to know every little thing that you do every 5 minutes of the day. So who must file? So business corporations, nonprofit corporations, limited liability corporations, limited partnerships, limited liability general partnerships, professional associations, business trusts. I don't know why they didn't just say everybody and get it over with. I don't know why, what do you have to go through the list for? Information needed, business name, jurisdiction. What is jurisdiction where? In Pennsylvania? Registered office address, principal office address, name of at least one governor, director, member, partner, etc., officers' names, Department of State file number, which, of course, they already have all this information, because if you do business in the state of Pennsylvania, what do you have to do? Oh, that's right. You have to register your business with the state, and you have to file forms, and then you have to start paying your quarterly taxes. So it's absurd that they are doing this, and then you have the filing process. Search for your entity on the business filing services, confirm update of your information, and then here's the cash grab. Pay the $7 fee. No fee for nonprofits. That was nice of them. Download your filed report within minutes. Oh, that's great. I get a report within minutes. So, and then here's the deadlines and compliance. So the annual report requirement begins in 2025. Your filing window is based on your entity type. So corporations have to file between January 1st and June 30th. Limited liabilities companies have to file between January 1st and September 30th. And then all others have to file between January 1st and December 31st. Failure to file an annual report will result in the administrative dissolution, termination, or cancellation of your business registration. So they're openly telling you that your business is already registered. But if you don't fill out these new forms and pay them the fee, then they're going to dissolve your registration. The Department of State will notify entities via email, if provided, and postcard before the deadlines. I have received nothing. I have heard nothing. I heard absolutely nothing about this until about a week ago. Nothing. And a good friend of mine he kind of shared this PDF with me, and he also, I'm going to click back onto. So this is the actual website, Commonwealth of Pennsylvania. So this is the annual reports in PA. And then what we were just looking at was this annual reports infographic. And then they have a bunch of, information on here for filing and frequently asked questions, other things. But the reason why, I'm going to go back to the infographic here for a second. The reason why I wanted to point this out was not so much for PA. I wanted to point it out because if PA is doing this, I guarantee you there are other states out there doing this as well. And I would absolutely, if you're a business owner, whatever state you're in, who's ever hopefully listening to this, I would go check with your state. If you haven't heard anything, I would go check with your state, maybe call local congressman or state senator or something like that, and basically ask them, hey, is there anything going on? Like I heard about BOI, but then I also heard that, Pennsylvania is doing this thing. Is our state doing anything in terms of requiring, business annual reports or any kind of new annual reporting? Because again, you want to be aware of these things and you want to try to stay on top of these things, but it's just I find it very, very frustrating because I'm sitting here going, why don't you just hang the sign that basically says, we don't want you to do business here. We don't want you to do business here. I mean, isn't it hard enough for small businesses out there? I mean, really, isn't it already hard enough? Don't they have to file enough paperwork? Don't they have to pay enough fees? I mean, at what point has the red tape just become so onerous and so ridiculous that people just throw up their hands and say, you know what, forget this. Like this is just ridiculous. This stuff really has gotten ludicrous. The amount of paperwork and just the nonsense that you have to go through just to operate a small business, not only in Pennsylvania, but in other states. I'm sorry. It's a hot button. I got a lot of hot buttons, right? Okay. So more to come on this without a doubt, I'm sure. But let's hit some other news real quick here. And then I'm going to run through some articles in the rest of our time here. So let's go through here. So commercial foreclosures rise as lenders approach an inflection point. And then where was the thing I had kind of highlighted on this? So commercial foreclosure activity across the nation crept up last month despite more positive sentiments overall across the commercial real estate industry. Foreclosure activity on U.S. commercial properties rose in September from the month prior to 695, according to Adam Data Solutions LLC. The property data firm's analysis includes total number of commercial properties with at least one foreclosure filing entered into its data warehouse during the month. But let's go down here. So Kevin Schwartz, Executive Director of Tri-State Debt and Equity Finance at commercial real estate firm Avison Young, said the market is starting to get to an inflection point where more lenders feel they have to make tough decisions. That goes for the borrowers too, who've realized interest rates haven't dropped as much or as quickly as they had been hoping for. And while there are some promising signals in the market, including an uptick in office touring activity, there are properties with loans that were set based on a 3.5% or 4% interest rate that are difficult to make work right now. Some of those assets were in extension and modification mode 2 years ago, and the time is up. The cycle has been going on a while, so there's starting to be some resolution. Most are foreclosing to stabilize the situation and sell the assets 6 to 12 months down the road. And then it says, what's next if I'll scroll down here, what's next? What's next for commercial loan activity? James Nelson, principal and head of Tri-State Investment Sales at Avison Young, said there haven't been a lot of public loan sales, and the expectation is that there will be more short sales in the market on properties facing issues. That's a departure from the global financial crisis, which also saw a significant amount of commercial foreclosure activities. So the rate cut issued by the Federal Reserve last month won't be enough to bridge the gap for a lot of troubled loans. But even if borrowing rates haven't come down as significantly as some groups would hope for, the fundamentals are getting stronger, and the psychology of the rate cut for investors is a positive thing. So many buyers and sellers have been choosing not to participate in the past few years, he said, adding investment volume in New York City in 2022 and 2023 was about 1/3 of what it had been averaging in the past decade. Even with some of the positive momentum felt within the industry in the past several weeks, many loans maturing will continue to be challenging to take out and replace, Nelson said, and no asset class is immune to the higher cost environment, financing and otherwise. So no asset class is immune. Financing and otherwise, the market is in today, Schwartz said, although office continues to face the biggest issues. So I thought that was a good update there on the commercial real estate scene. I believe this is absolutely accurate. You know, we are heading into an inflection point. You have seen banks doing what's called extend and pretend, trying to push these loans off in the hope that interest rates would come down and that would kind of bail them out and their borrowers out. But like the article said here, I think we're reaching the point here where banks are basically saying, you know what, we've been extending this thing for 6, 12, 18 months, 2 years. We've kind of reached a point where it's like, okay, we're not going to get the rates down low enough, fast enough, and we're going to have to do something here at some point. And it is what it is, we're going to have to make some very tough decisions coming up real soon. So I thought that was good on that. Then next thing we have here is SBA lending increases. Agency takes steps for more growth in 2025. So the Small Business Administration lending programs reached more small businesses over the past 12 months than at any point in the last 15 years. And the agency is poised for growth in new areas in 2025. So newly available data from the SBA shows that the agency increased its annual capital impact of $56 billion in fiscal 2024, which ended September 30th. That's up 7% from fiscal 2023. Additionally, the fiscal 2024 funding was connected to 103,000 financings, up 22% from fiscal 2023, the highest annual count since 2008. As every entrepreneur knows, capital is critical. It's integral to business owners at all stages of their journey, from startup to growth and resilience. Thank goodness they were there to tell us that. Through loans, investments, and surety bond guarantees, the SBA has helped power the small businesses that have in turn powered America's unparalleled economic activity and recovery through COVID-19 crisis. Okay, so SBA loans are up. The SBA is looking to expand its lending efforts, so that's great. We'll see what happens with that. Okay, because we all know the SBA has done a wonderful job with EIDL loans, but well, no, they haven't, not so much. So anyway, all right, I don't want to be mean. I don't want to be mean. All right, so let's all right, a couple more things here for you guys. Here we go. Let's look at all right, McDonald's. McDonald's reported mixed results. Revenue adjusted profit tops expectations. So let's go down here. McDonald's reported mixed third quarter results Tuesday with revenue and adjusted earnings topping analyst estimates, but net income and same store sales coming in worse than expected. So the fast food giant registered $6.87 billion in revenue, up from $6.69 billion last year, and the $6.91 billion analysts expected, according to consensus estimates. But McDonald's also posted $2.26 billion in net income, down from last year's $2.32 billion and the $2.3 billion analysts projected. After stripping out nearly $70 million in charges, McDonald's adjusted net income of $2.32 billion narrowly beat estimates. The chain, and here's the most important thing. The chain also reported a 1.5% decline in same-store sales, with a small bump to U.S. sales and declines internationally after reporting a 1% drop in the second quarter, when executives said higher prices were driving lower-income customers away. Analysts expected a decline of about 0.6% in comparable sales, with nearly flat sales in the U.S. and lower sales internationally. So, as you can see, McDonald's is still struggling, and this is a problem. I mean, if your market is basically, a lot of it is selling to lower income families, and I always point to fast food. Fast food is a great barometer. It will tell you how the economy is doing. If fast food is doing really well, that means that lower income people, they've got lower income families, middle class families. They got some money. They're out. They're buying Mickey D's. If the Mickey D's is having problems, if there's store sales are going down for Mickey D's, then, or if they're struggling to make their numbers, that tells you that the economy there is wavering, especially with with lower income and middle class families, so that buy a lot of McDonald's. And again, I think that can go for Wendy's, for Burger King, for Chick-fil-A. You look at all of them and see what's going on, and that will give you a great indication of the economy. So like I said, just wanted to note this, that McDonald's, even though their numbers are still kind of hanging in there, they're seeing a continued decline in same store sales, which means that people are buying less. They're charging more, but buying less. And look, you can see here, the third quarter also saw McDonald's announce the extension of its $5 meal deal promotion into December rather than its originally planned summer run. So again, they're trying to get people to come back in and buy more than just one thing or one meal, or come back in, buy a ton of stuff. So, but not really happening, if you will, at the moment. So. Okay. I wanted to report on this. So manufacturing activity in the Philadelphia region expanded overall, according to the Federal Reserve Bank of Philadelphia, according to their October Manufacturing Business Outlook survey. Indicators for current general activity, new orders, and shipments increased this month, with the latter two returning to positive territory. The employment index indicated mostly steady employment conditions. Meanwhile, both price indexes showed price increases. So manufacturing activity in the Philly region's hanging in at least okay for the moment. So let's look at something here before I jump into some other news. So let's look at this. So this is, I thought was interesting. So this is kind of like reflecting on banks' top concerns for 2024. So as this year nears its end, reviewing the industry's toughest challenges can help with planning for 2025. So, and this was an article on Bank Director, written by Peter Chirpek, who is the EVP, Senior Director of Credit Technology. So taking a hard look at your financial institution's challenges can help you fine-tune your approach in the coming year and beyond. With that in mind, here is a review of some of the key developments from this year. So the CRE crisis lingers for community banks. M&A is trending up. The loan review and credit risk. The loan review function in most commercial banks is a key part of proactive credit risk management. Then we get into climate-related credit risk. So regulators are increasingly viewing climate risk as credit risk, while regulators are not considering the carbon footprint or environmental impact that a potential lender can create. They are asking banks to consider whether a flood, earthquake, or wildfire would render borrowers ineffective or delinquent. And then finally, artificial intelligence growing slowly at many banks. AI, particularly generative AI adoption, is becoming widespread across all sizes of financial institutions. I don't know. Is it really? I mean, is it really? I don't know. I don't know about that. I think certainly J.P. Morgan is going nuts with it. Some of the other bigger banks are diving into it. But I mean, are thousands of smaller community banks across the U.S. diving into AI? I like I said, I don't know. I think maybe some banks kind of dip a toe into it, maybe. But again, it's on the horizon. It's there. I mean, I'm sure. So like I said, I'm sure some people are looking at it or messing around with it, but this idea that like, oh yeah, every bank is just jumping right into AI. Like, no, I don't see. So all right. So again, just to recap real quick, commercial real estate crisis still lingering. M&A trends are up a little bit. Loan review and credit crisis, climate related credit risk, and artificial intelligence growing slowly at many banks. So, okay. Now I want to jump in. You know what? I'll tell you what, let's do this. Let's jump on here to good old X for a minute here. And let's just look at some of the charts and graphs that I have saved here for everybody. So this was from yesterday. So September PCE inflation, the Fed's preferred inflation measure, falls to 2.1% in line with expectations. However, core PCE inflation was unchanged at 2.7%, above expectations of 2.6%. It has been 6 months since core PCE has fallen. So 6 months since core PCE has fallen. Interest on the debt in the third quarter was an annualized $1.117 trillion, a new record. While the pace of increase has slowed, it's still on track to hit almost $2.75 trillion by the decade's end. Just absolutely insane. You just see that chart tells it all, man. I mean, just look at that explosion. It's just crazy. And it said, U.S. job openings fell by 420,000 in September to 7.44 million, kind of what we talked about earlier. U.S. available job vacancies significantly missed expectations of 8 million. Since the March 2022 peak, job openings have now declined 4.74 million, or 39%. Like I said, they were, a little over $12 million. And you can see there in the chart that basically, things just continue to tread in a downward fashion there as the labor market continues to decelerate. Excuse me, I need a sip. Got to keep me going here. Got a few more minutes left here. Okay, so here's the increase in the federal debt and the increase in GDP. What do you notice? And like I said before, government change in federal debt on the left-hand side here in the red, change in nominal GDP. So you can see here again, government spending driving GDP. Look at this chart. Federal debt jumped 31 billion yesterday to a new record high of 35.849 trillion. It's up 384 billion since the start of the month. 384 billion since the start of the month. Well, just look at that. I mean, just incredible. Unbelievable. Okay, U.S. home buyers have lost $33,250 in purchasing power over the last 6 weeks as mortgage rates have spiked. A homeowner with a $3,000 monthly budget can now afford a $442,500 home, down from a $475,000 house on September 17th, the lowest since February of 2023. So, obviously affordability going down. And here is probably my favorite chart right here. I wonder if I can make this a little bit bigger for everybody. Yeah, here we go. Okay. Should have done that before, right? All right. So at the bottom here, you see this is where the Fed cut by 50 basis points here in September, like September 20, what is that, September 22nd? And this chart is for the 10-year Treasury yield. And what has the 10-year Treasury yield done since then? It has gone straight up like a rocket. Right here. So we have gone out from a low of about 3.6%, and now we're pushing 4.3%. So we've gone up, what is that, 40? So yeah, rocketed it up about, no, it's not that much. Yeah, I guess it is. I guess it is about 70 basis points. Yeah, going up about 70 basis points here inside of a month. Yeah, those Fed rate cuts doing real good. Yeah, mortgage rate hitting an all-time high here. So, U.S. layoffs jumped by 160,000 in September to 1.83 million. We kind of talked about that a little bit. This is what happens when your auditor says they can no longer trust your financial statement. So super microcomputer, look at that chart for anybody that doesn't know. So super microcomputer is like the biggest purchaser of NVIDIA AI chips. And so they're like their biggest vendor for NVIDIA. And they basically have not reported their financial earnings. And in other words, they haven't filed their tax returns. They haven't filed their, I don't think their 10K. And they, this week, their auditor came out and basically said that they, couldn't issue any confidence in the company's financials. And so their stock plummeted like 35% in like, I don't know, like a half hour or something. That's a crazy chart to look at right there. Yeah. Pretty nuts. So obviously they got super microcomputer has some problems. And the question is there some shenanigans between them and NVIDIA? And, what was kind of going on there? I've read a bunch of different things. I've seen some grumblings. I'm not really going to comment on right this minute. I would rather like to see kind of like what happens or how that plays out. But no doubt, I think one way or another, the issues with super microcomputer are going to find their way back to NVIDIA at some point. So, but like I said, stay tuned. Look at that. That's interesting, right? 41 billion of the World Bank's climate change fund has gone missing. You don't say. Only 41 billion. The car market bubble. 33% of Americans who finance their cars now owe more on their loans than their vehicle is worth. This represents 31 million auto loan accounts registered by the CFPB. Making things worse, used vehicle prices in the U.S. have continued to increase. Average amount of negative equity, look at that, 21, 22, 23, 24, just going up. 4,200. 4,800, 5,600, 6,400. Share of trade-ins with negative equity going up there. Look at that, 24% in 2024. 24% of trade-ins are traded in with negative equity, meaning the car company's not giving you any money for taking that car in. My favorite. The U.S. Treasury plans to borrow $1.37 trillion over the next 6 months. Really? You have to be kidding. Every single person responsible for this should be fired. I don't necessarily disagree with that. And like I said, the 10-year Treasury note hitting 4.3%. This was kind of funny. This was a video of Janet Yellen doing a press conference. As you can see, the board here falls off. So a few days ago, Janet Yellen was answering, "How concerned are you about the long-term status of the dollar?" And while she was sitting there, the board fell off the podium. Very apropos, if you will. Let's see here. Finance lot. If anybody ever checks him out on X, great account to follow if you ever get a chance. 4.29%. It's 1968 all over again, where no one wants to buy U.S. Treasuries. Interest rates are about to double to 9%. Yes, he's not wrong there. He is not wrong. And then finally, I'll finish up with this one before I get to some other news here real quick. So, wow, the banks are currently sitting on $750 billion in losses on real estate debt. This number is 7 times larger than it was in 2008 when the housing bubble popped. So this is from an article from Benzinga. U.S. banks sitting on $750 billion in losses on real estate debt related securities. Which sectors are most exposed? So. And then here you go. I'm sorry. I got one more thing for you here. So breaking. Central banks now hold 12.1% of the global gold reserves, the highest level since the 1990s. This percentage has skyrocketed this year and has more than doubled over the last decade, with China, India, Turkey, and Poland have been the largest contributors to global central bank gold holdings. Yes. What does that tell you? If the central banks are buying a ton of gold, that tells you they are worried. They are very, very worried about things, because they wouldn't be buying gold if otherwise, because I love how central bankers, they will always kind of talk smack on gold, but then they're out buying it all day long, all day, every day. That's the truly one of the truly funny things. They'll sit up there like, gold is not a great hedge. And, gold doesn't pay you any money. It doesn't pay you a dividend. It really doesn't do anything. So you really shouldn't buy that gold. But then as soon as the press conference is over, they're on the phone. Hey, we need more gold. We need more gold. Buy, buy, buy. They're like Jim Cramer up there. Buy, 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 buy. All right. So let's see here. What else do I got here? Okay. So before, let's see here. What else do I got? I did want to run through some other things before I kind of run through these last articles here. I got a few minutes left. Kind of went through a lot of these economic indicators here. So let me hop out of that for just a second. Let me read through here some things for you guys. So Zelle, if anybody's on the Zelle network, so Zelle is phasing out of their standalone mobile application. So basically, Zelle said it is discontinuing its standalone app because most people use Zelle through their financial institution's mobile app or online banking experience. So the peer-to-peer payment platform said over the next few months, it will phase out the ability to enroll and transact with the standalone app. It will encourage those who use the standalone app to instead start using Zelle through a participating financial institution. And the app will henceforth provide consumers education about scams and fraud and provide a list of the more than 2,200 banks and credit unions that offer Zelle. So Zelle said consumers and small businesses moved nearly $500 billion on Zelle in the first half of this year, with roughly 2% of transactions on the standalone app. ICBA. Agencies should publish supervisory highlights on bank fintech partnerships to counteract regulation through enforcement. ICBA urged federal banking regulators to periodically publish supervisory highlights on key examination findings related to bank fintech partnerships, similar to what the Consumer Financial Protection Bureaus. So it's interesting to have to keep an eye on that. ICBA credit union penalties exemplifies consumer impact of lagging oversight. The ICBA said a new regulatory action against the ViStar Credit Union for harming consumers through its botched rollout of a new online banking system exemplifies the risks posed by lagging credit union regulation. The ViStar penalty, the Consumer Financial Protection Bureau said ViStar transitioned to a new dysfunctional online banking platform in May of 2022 that made it difficult for credit union members to perform basic banking functions for weeks or months. It ordered ViStar to make affected consumers whole and pay a $1.5 million civil penalty to the Bureau's Victims Relief Fund. So it's kind of interesting. Apply CRA to credit unions. Key consumer groups say the National Community Reinvestment Coalition called on policymakers to subject credit unions to the Community Reinvestment Act. In a new American Banker op-ed, President and CEO Jesse Van Toll wrote that the credit union industry is an exceptionist sector whose most significant members aggressively market their services nationwide and offer services that look a lot like those of traditional banks. Credit unions want to operate like a bank, then they should be regulated like banks. I absolutely 100% agree. Grunberg. Orderly resolutions without systemic risk exemptions needed. FDIC Chairman Martin Grunberg said there is a need for meaningful action to improve the likelihood of orderly resolutions of large regional banks without the expectation of invoking the systemic risk exceptions. So speaking, this is my favorite part, speaking in Germany, Grunberg said the FDIC and other financial regulatory agencies are taking steps towards that goal, including via a long-term debt requirement for large regional banks. This is one of my biggest pet peeves. Why do our regulators have to go overseas to give a speech about what they're doing with American banks here in the US? Like, this is like, it's mind-boggling. Like, dude, do a Zoom call. It's 2024. Do a Zoom call, or hey, get on YouTube. There's an idea. You don't need to be spending taxpayer monies flying to Germany to give a basic speech on things you need to be done in dealing with regional banks here in the U.S. It's absurd, man. It's not, you're not going to Davos. Like, this is like and again, that's the point. Like, this is just BS. It's a way for these bankers on the taxpayers' dime to go, not bankers, I'm sorry, regulators. It's a way for regulators, the people at the Treasury and the Fed, to go gallivant around the world on the taxpayers' dime. And it's absurd. And anyway, and then here's a better question. Why is Martin Gruber, why is he even still at the FDIC? This guy oversaw one of the greatest disaster and calamity in the history of the FDIC, and this clown is still running the show over there. How? That guy should have been fired 6 months ago. But it is interesting. I will note, it is interesting that, like, why are they so concerned about the orderly resolution of large regional banks if they basically get into trouble? Like, I'm not totally sure if they would be pushing that if they didn't think there wasn't something to be worried about. Okay, and then furthermore, he went on to say in some of his other comments, FDIC deposit requests could lead to new reporting. So the FDIC request for information on different types of deposits will help the agency better understand the dynamics of deposit funding. Well, we'll see. Treasury announces final inclusion strategy with crucial bank role. The Treasury Department said banks have a crucial role in financial inclusion, including developing products, leveraging technology for broader access, and partnering with community organizations. And here I thought banks weren't already doing all of that. Apparently, we needed the Treasury to come along and tell us to do all the things that they're already doing. FHFA announces Fannie Freddie policy updates. So the Federal Financing Housing Agency announced updates to several Fannie Mae and Freddie Mac policies that it said are intended to enhance efficiencies and promote cost savings in the single-family mortgage market. Also, in addition, FHFA and HUD issue a new set of appraisal data. The Federal Housing Finance Agency and Department of Housing and Urban Development published a new set of data points and trends found in appraisal reports. The new uniform appraisal data set, appraisal level public use file contains details on approximately 266,000 single-family appraisals from the Federal Housing Administration insured mortgages conducted from 2017 through 2022. So interesting, probably some interesting data in there. OCC developing operational resilience proposal. Okay, the OCC is developing an advance notice of proposed rulemaking on operational resilience standards for critical operations. And then, okay, let's see here. And then anything I got. Oh, you know what? I thought I had. Did I bring this up? I thought this was good. Yeah, here we go. Okay, so JP Morgan reportedly sues customers for infinite free money glitch. I thought this was an interesting story. So, JP Morgan Chase reportedly filed lawsuits on Monday against customers who allegedly acted on a social media promoted infinite free money glitch and stole thousands of dollars from its ATMs. The viral videos described a loophole that included depositing fake checks for large amounts and withdrawing funds before the checks bounced. Days after the videos were shared, JP Morgan Chase clarified that this was check fraud. The bank reportedly has filed lawsuits in at least 3 federal courts against those who withdraw the highest amounts and is seeking the return of the stolen funds plus other interest and fees. Yeah, so that was real interesting. If nobody saw the videos on social media, they some of them were, I have to admit, some of them were a little funny. It was kind of like, people running in like, hey, look, put this check in on your mobile deposit and then run over to the APM and get in. And it's like, it's free money. And it's like, no, it's not free money. Like, that's check fraud, and that check is going to bounce, and your account's going to go negative, and the bank's going to be calling you up going, yo, dude, you owe us money. So, but yeah, it was an interesting thing. So, okay. Let's see here. What else do I got here for everybody? Let's go. I wanted to show everybody some different. All right, so let's run through. Got 5 minutes left here. Let's run through some other things. So many retail commercial real estate lenders keep exposure largely unchanged in the third quarter. Several U.S. banks that are active lenders on retail commercial real estate properties kept their exposure steady in the third quarter. U.S. banks book lower than projected provisions as credit issues stay contained. Most U.S. banks that released their third quarter financial results through October 25th posted lower provisions for credit losses than analysts expected as credit issues were well contained. Maybe we shall see. Time will tell. Obstacles remain for U.S. bank IPOs amid renewed investor interest. So the U.S. banks looking to go public still face ongoing challenges, even though the rate outlook has helped improve investor sentiment in the space as stock valuations have risen. PayPal shares slid on soft fourth quarter revenue guidance. PayPal holding stock dropped after the company reported its results for the third quarter as investors priced soft revenue guidance. So for the revenue in particular, PayPal is anticipating growth in the low single-digit percentage range as a result of its contract repricing initiatives and elevated market spend. I was just looking for something here real quick. So, yeah, PayPal has been going through some issues lately. They kind of made some political blunder earlier this year that led to some kind of basically a little bit of a boycott. I believe they kicked their CEO out, and they've got a new CEO now. And yeah, and so they're just PayPal's just been going through some stuff over there. So. All right, U.S. housing market. Home prices rise slows in August. So U.S. home prices continue to rise in August, though at the slowest pace since the beginning of 2024. Quaint Oak enters sale leaseback transactions. So I've reported before on sale leasebacks, and they kind of banks using that as a strategy. I just want to show that trend is continuing. U.S. regional banks failed to log year-over-year earnings growth in the third quarter. Most U.S. regional banks that reported earnings for the 3 months ended September 30th logged lower financial results year-over-year. BOA weighs litigation in CFPB's Zelle inquiry, engages regulators on compliance. Banks take advantage of third quarter 2024 window to unload low-yielding bonds. So, yes, basically a number of banks that were still sitting with basically, with what we have classified as unrealized losses in their bond portfolios have been dumping some of that, even at losses, but still, you can see a lot of red there in that chart. AFS is available for sale securities. So basically, dumping a lot of that off. So, okay, some U.S. banks face long-standing severe enforcement actions. Yeah, like Wells Fargo and now TD Bank. Average delinquency rate for 6 credit card issuers continues ascent in September. Yep, credit card delinquency continues to nudge upward. MasterCard debuts commercial payment-focused products. MasterCard unveiled MasterCard Move Commercial Payments, a product allowing banks to facilitate near real-time, predictable, and transparent commercial cross-border payments. This product will aid banks in transforming corporate trade payments and intracompany and intercompany treasury flows. So that's interesting. We'll see what happens with that product. Most large U.S. banks record deposit gains and improved net interest margins in the third quarter. So most large banks in the U.S. grew deposits in the third quarter following a pullback a quarter earlier as intense competition recedes with the start of Federal Reserve interest rate cuts. We shall see if that trend continues. And then I talked about, layoff surge in U.S. white-collar jobs. Talked about that earlier. So, okay. That, as they say, is all I've got for you guys this week, man. Thought that was a lot of stuff. So, okay. I announced before that I was working on the kind of financial history series. I am hoping to have that first episode out this month in November, maybe toward the end of the month. I might even save that. I might even save the first episode kickoff on that. Is kind of like, maybe I'll do that as like a Thanksgiving special kind of thing. Maybe give you guys something to watch over the Thanksgiving weekend. I am very highly considering doing a special live stream tomorrow night. I have a lot of crypto news, and I was thinking about putting that out in a number of individual episodes as part of the crypto series. I'm thinking about, I haven't made the official decision. I will put out if I decide to do it tomorrow, I will put out a post tomorrow morning about it. If I don't, I'll save it for next week. But like I said, I might do this, and this live stream I'll still put this in as kind of as an episode of the crypto series. But like I said, I'm thinking about doing this tomorrow night on Saturday night. But like I said, I'll see what happens, and I'll confirm for everybody tomorrow. So, but stay tuned. I got a number of episodes coming out this week, a number of great reports and other things that have come out here over the last few weeks to get to, a ton of banking stuff to check out and to continue going on. Hoping to have some more interviews coming up for everybody here in the not too distant future. And with that, I'll say goodbye. Thank you, everybody. Sincerely, thank you for being in the strategy room. Thank you for watching. I appreciate it. Check out some of the other content, some of the episodes on the channel. Remember, we are on YouTube, Rumble, and all the major podcast platforms. So you can check us out on Spotify, Apple Podcast, Google Podcast. You know the drill, so on and so forth. And definitely, leave your comments down below. If anybody has any thoughts, I always love getting back to the audience members. And if you have any ideas for episodes, like if there's anything that you've maybe ever wondered about or something in the news you saw that you'd like me to talk about a little bit more in depth, let me know. Always happy to talk about stuff. And as obviously that's why I'm here. But again, I hope everybody has an awesome weekend. Keep an eye out for tomorrow. Like I said, if I confirm to do the crypto live stream tomorrow night, just keep an eye out for that. And like I said, I'll let everybody know. If not, I'll just make an announcement and I'll do it next week. But we'll see what happens. But until then, see everybody later. Thank you so much, and have a wonderful weekend. And keep an eye out for some of the other episodes I'll be posting up. So see everybody later.